The Canadian permanent portfolio achieved an 11.3% rate of return for the 6 months beginning this year. This is on top of the 7.3% that was earned in 2023. In the chart below, one can see that we had some very strong performance in gold and silver along with U.S. equities. We rebalanced the gold and silver in late May 2024 and sold roughly 9% of the total gold and 18% of the total silver to get back to their 20% and 5% respective weightings. We rebalanced the gold and silver weightings early this year because of the sharp move in both of their values. Beginning in March of 2024, gold and silver had gone almost parabolic, and we wanted to take the gains. We are currently in the process of moving out of the short-term bond holding. The XSB ETF holds a combination of government, 70%, and corporate bonds, 30%, ranging from 1 to 5 years in duration. We will be replacing it with a T-bill fund that buys and holds 90-day Treasury bills. We are doing this move to get back to the original permanent portfolio strategy of having 20 to 25% of the portfolio in cash. The current yield we will receive on the Treasury bills is approximately 4.75%, which is actually higher than the current rate on the XSB, which yields 4.22%. Late in 2022, the Government of Canada announced that they will no longer be issuing real return bonds. For the Government of Canada currently, debt to GDP is at an all-time high, and it is likely that they will try to inflate away the value of this debt. By paying rates above the inflation rate on real return bonds, which is currently 1.6% above inflation, this is a cost they do not want to bear. The next 6 months could be a very tricky time for investors. We have never seen more serious economic and geopolitical turmoil than we are potentially seeing now, and this could affect quite dramatically the global financial markets. Currently, there are two ongoing wars, Russia-Ukraine and Israel-Palestine. The outcome in these conflicts are far from certain, and it is quite possible that these tensions could flare significantly. There are no real peace initiatives in either crisis currently. These conflicts have the potential to affect asset prices in a very large way. In the second quarter of 2024, it has become apparent that the economies in North America and Europe are starting to weaken. We have seen weakness in the spending data and in some of the quarterly numbers that companies are now beginning to report. There's no doubt that the rise in interest rates from 0 to 5.5% in the U.S. over the past 2-year period from 2022 to 2023 are really starting to seep into the economy. Servicing debt has become much more expensive. The U.S. and many European countries are currently running huge budget deficits. In fact, the U.S. is projected to have over a $2 trillion deficit for this fiscal year. How these deficits get financed is a major question, specifically for the U.S. Over the past 2 decades, countries such as Japan and China had been major buyers of U.S. debt, but this has completely reversed over the last several years. In fact, they are now big sellers of U.S. bonds, and this could create real problems. It is quite possible that the U.S. interest rates, not the short-term Fed funds rates, could go higher as a result of buyers demanding higher interest rates to compensate for a government whose fiscal situation is questionable, and to protect against the current and future inflation that we have and will likely continue to experience. The factors mentioned above are real financial risks to the markets and economies of the globe. Individual investors need to be aware of this and protect their portfolios from it. It is important to note that currently stocks, bonds, and real estate are all at or are close to all-time highs. This is a bit surprising given the fact that interest rates have risen sharply over the past 2 years. We believe that the focus for all investors should be the preservation of capital at this time. Our permanent portfolio with its 20% gold and 5% silver weightings provide this level of safety. We've included a chart below of the 1970s performance of Harry Brown's permanent portfolio model demonstrating how important a 25% gold weighting was to investors during this period. Instead of having a negative real return on cash, bonds, stocks, and real estate, although that's not part of Brown's model, the gold holding turned these real losses into a very significant positive real rate of return on the portfolio, specifically a 6.6% real rate of return on the portfolio, despite 3 of the 4 assets in it experiencing real losses. We believe that we could be in for a decade very similar to the 1970s currently.